Manchester's property boom has been the envy of the UK for years, but beneath the cranes and glossy brochures, cracks are forming. Some areas are dangerously overheated, flooded with unsold units, and teetering on the edge of a serious correction. By 2026, certain postcodes could see values plummet. If you're invested in Manchester property or thinking about it, you need to know which areas are most at risk. This is the countdown you can't afford to ignore. Let's start at number 10, but before we get started, be sure to subscribe to our channel and ring the bell to get notified about our latest videos. Number 10. Ancoats. Ancoats has been hailed as the coolest neighborhood in the UK, but that hype may have inflated prices beyond sustainable levels. The area has seen a flood of luxury apartments aimed at young professionals and investors, yet rental yields are stagnating. Demand is softening as affordability becomes a real issue, and many units remain unsold or struggle to find long-term tenants. Developers continue to push new builds onto the market, creating a dangerous oversupply. With interest rates still elevated and buyer sentiment cooling, Ancoats could see a sharp correction. The fundamentals simply don't support current valuations, and 2026 may expose that reality. But Ancoats isn't alone. Number 9 is facing even deeper structural issues. Number 9. Salford Quays. Salford Quays has long been a magnet for investors, but the shine is fading fast. The area is saturated with high-rise developments, many of which are struggling to attract quality tenants. Service charges are high and resale values have flatlined in recent years. What was once a symbol of regeneration now feels like a speculative bubble waiting to burst. Investor appetite is waning, and many are quietly offloading properties before the market turns. The reliance on buy-to-let demand makes Salford Quays particularly vulnerable to economic headwinds. If mortgage rates remain high and rental demand softens further, prices could slide significantly. This isn't speculation, it's a pattern we've seen before in overbuilt areas. And speaking of overbuilding, number 8 takes it to another level. Number 8. Green Quarter. Green Quarter promised an urban oasis in the heart of Manchester, but it's become a cautionary tale of overdevelopment. The area is packed with nearly identical apartment blocks, and the market is flooded with available units. Rental voids are increasing, and landlords are feeling the squeeze. Property values have stagnated, and there's little to differentiate one building from another. The lack of unique character or community feel has made it difficult to sustain long-term interest. Investors who bought off plan are now struggling to achieve the returns they were promised. With more development still in the pipeline, the oversupply issue will only worsen. Green Quarter is a textbook example of a market that expanded too quickly without solid demand to support it. But if you think that's concerning, wait until you hear about number 7. Number 7. Media City UK. Media City UK was built on the promise of a thriving creative hub, but the reality hasn't quite lived up to the vision. The area is heavily reliant on a narrow tenant base, predominantly BBC and ITV employees, and that creates vulnerability. Recent shifts towards hybrid working have reduced demand for city center living, and Media City UK has felt the impact. Rental growth has stalled and resale values are under pressure. The development pipeline remains aggressive, adding more supply into an already saturated market. Service charges are among the highest in Greater Manchester, eroding investor returns. If major employers downsize or relocate, the knock-on effect could be severe. Media City UK's future hinges on factors beyond its control, and that's a risky position to be in. And as we move into number 6, the risk becomes even more pronounced. Number 6. Northern Quarter. The Northern Quarter has character in spades, but it's also become a victim of its own success. Property prices have surged on the back of its trendy reputation, but the fundamentals are shaky. The area is dominated by older conversions and smaller units that appeal to a niche market. As affordability worsens, that market is shrinking fast. Rental yields are modest at best, and many landlords are finding it hard to justify holding onto properties. The northern quarter's infrastructure is aging, and without significant investment, it risks losing its appeal. Meanwhile, newer developments in other parts of the city offer better value and modern amenities. If buyer sentiment shifts, the northern quarter could see a sharp decline in property values. It's a beloved area, but sentiment alone won't protect prices, and number 5 is facing a similar identity crisis. Number 5. Spinning fields. Spinning fields is synonymous with corporate Manchester, but its residential market is under serious strain. The area attracts high earners, but affordability is becoming a barrier even for that demographic. Rental demand is softening as hybrid working reduces the need to live close to the office. Property values have plateaued, and there's little sign of upward momentum. The market here is highly sensitive to economic conditions, and any downturn could trigger a wave of distressed sales. Service charges are eye-watering, and maintenance costs continue to rise. For investors, the numbers simply don't add up anymore. Spinning fields may retain its prestige, but prestige doesn't always translate into strong property performance. And as we approach the top 4, the warning signs become impossible to ignore. Number 4. Deansgate. Deansgate is one of Manchester's most iconic streets, but its property market is teetering on the edge. The area is packed with luxury apartments that were marketed to international investors, many of whom are now looking to exit. Rental yields are disappointing and resale values are stagnant. The market is flooded with similar properties, making it difficult for sellers to stand out. High service charges and maintenance fees are eating into returns, and tenant demand is softening. Deansgate's reliance on the premium end of the market makes it particularly vulnerable to economic uncertainty. If confidence wavers, prices could fall quickly. The area's reputation may be strong, but the fundamentals are weak. And number 3 is facing an even more precarious situation. Number 3. Castlefield. Castlefield was once seen as a hidden gem, but it's now showing signs of serious distress. The area is dominated by older developments that are beginning to age poorly. Maintenance issues are mounting, and service charges are rising to cover repair costs. Rental demand has softened, and many landlords are struggling to find reliable tenants. Property values have stagnated, and there's little prospect of growth in the near term. Castlefield lacks the vibrancy and amenities that attract today's renters and buyers. Its canal-side location is charming, but charm alone won't sustain a property market. Investors who bought here a decade ago are now facing difficult decisions, and as we move to number 2, the stakes get even higher. Number 2. New Islington. New Islington was supposed to be a flagship regeneration project, but it's become a cautionary tale. The area is oversupplied with apartments, many of which remain unsold or unoccupied. Rental yields are poor, and landlords are finding it increasingly difficult to cover their costs. The development lacks cohesion, and the community feel that was promised has failed to materialize. Infrastructure improvements have been slow, and the area still feels disconnected from the city center. Investor confidence is evaporating, and many are looking to cut their losses. New Islington's future depends on factors beyond the control of individual owners, and that's a deeply uncomfortable position. If the market turns, this area could be one of the hardest hit. But there's one area that stands out as the most vulnerable of all. Number 1. Piccadilly Basin. Piccadilly Basin takes the top spot as the area most at risk of a housing market crash in 2026. The problems here are structural, deep-rooted, and unlikely to be resolved quickly. The area is saturated with high-rise developments that were built to capitalize on short-term investment demand. That demand has dried up, and oversupply is now a critical issue. Rental voids are increasing, and property values are under serious pressure. Service charges are among the highest in Manchester, and many owners are struggling to break even. The area lacks the amenities and transport links needed to attract long-term residents. Piccadilly Basin's market was built on speculation, and when speculation ends, prices fall. If you own property here or you're considering buying, the risks are real and immediate. This is the area to watch and possibly avoid in 2026. So guys, Manchester's property market has been a success story, but not every area will come out unscathed. The 10 postcodes we've covered today are all facing serious headwinds, from oversupply to investor pullback and economic pressure. If you're invested in any of these areas, now is the time to reassess your position. Drop a comment below and let us know. Are we right or are we missing something? And if you found this useful, hit subscribe and stay ahead of the market. Thanks for watching.